All right, welcome back to Theta Fuse. It's Monday, February 9th, 2026. And look, I want to start things a little differently today.
Oh, yeah. How so?
Well, usually we kind of ease into the week. We talk about what's setting up. But if you haven't looked at your screens yet this morning,
Don't.
yeah, seriously, don't open your brokerage app while you're driving. I'm not kidding.
It is one of those mornings.
It is. Stop what you're doing, grab a coffee, sit down, and let's just take a collective breath. Because what we're seeing is a massive, a violent divergence in the markets.
That's the word for it, divergence.
And it is going to affect how you play the rest of this week and probably the rest of this quarter.
I think so, too. We talk about correlation all the time. For the last few years, it's been this everything bubble idea.
Right, a rising tide lifts all boats.
Exactly. When the liquidity tap is on, everything floats. Tech, crypto, real estate, you name it. When it's off, everything sinks together. But
Today's different.
Today, we are seeing a complete decoupling. Assets that people for a long time thought were brothers, they're now enemies.
It really feels like the market is being ripped in two different directions at once.
Yeah.
Let's just put it in the simplest terms, right at the top, because this is what hits your wallet.
Go for it.
Okay. If you are holding digital gold, Bitcoin, as your hedge against, the world going crazy, you just took a serious, serious hit to your buying power. We were talking about a flush that hurts. But if you are holding actual physical shiny gold,
You're having a very, very good morning.
you are probably popping champagne right now. It's that stark.
That really is the story of the day. It's the tale of two so-called safe havens. You've got Bitcoin flushing violently below $70,000. It even hit lows near 60K recently.
Testing levels that make people sweat.
Oh, yeah. And at the exact same time, gold has just shattered the $5,000 ceiling.
Yeah.
It is. It's a massive wake-up call on what's a real hedge and what isn't.
It's the war shout. Isn't that what the trading desks are calling it?
Ha! That's a new one for me, but I like it. The war shout.
We are definitely
Yeah.
going to tear that apart. The whole Kevin Warsh effect. Why his name alone is sending these shivers down the spine of the entire crypto market.
But it's not all doom and gloom.
No, absolutely not. Because while everyone's watching the tech giants stumble, we have to talk about the small cap revenge.
The little guys are finally having their day.
They really are. The Russell 2000 is, it's putting points on the board while the superstars are on the bench.
And that's a rotation that a lot of savvy investors have been waiting for. Plus, you can't ignore the M&A news. Eli Lilly is on a billion-dollar shopping spree.
A huge one. And we'll touch on some interesting moves in Brazil and Japan that, they tell us a lot about the global liquidity picture.
A packed day.
It is. And of course, stick around to the end. We've got the investment strategy of the day. We're going to break down how you can actually play this earnings beat in small caps. And maybe how to hedge some of that crypto risk.
Sounds good.
But first, let's start with the chaos, the crypto crash and the gold rush.
Let's dive in.
Okay, so Bitcoin. Monday morning, New York open. We're looking at a price hovering around $68,540. It slipped below that huge psychological 70K barrier.
But that number, 68,000, it doesn't even tell the whole story, does it? The last few days have been a complete roller coaster.
Roller coaster is putting it mildly. If you just rewind to last Thursday.
We saw that plunge all the way down to $60,033.
60,000. That's the lowest level since October of 2024. Think about that.
It wiped out months of gains. Basically, all the optimism from the post-election period, the whole up-only narrative from the end of last year.
Gone
in just a few trading sessions.
So the Trump trade games, as people were calling them, are effectively erased for now. And even though we got that little, that dead cat bounce on Friday back above 70K.
It didn't hold.
It didn't hold. Here we are Monday, sliding right back down.
Yeah.
So the big question on everyone's mind, the one I'm seeing everywhere in our comments and my DMs, is why? What changed so fast? Why is the floor suddenly falling out?
You have to look at the macro picture.
Yeah.
And specifically, you have to look at the Federal Reserve.
Or the future of the Federal Reserve.
Exactly. The market is reacting, maybe overreacting, to the nomination of Kevin Warsh to succeed Jerome Powell. And I think we need to really spend some time here.
I agree.
Because to the average person, switching the Fed chair is like, just changing the nameplate on the door. But to the market, this is a potential regime change.
Okay, let's unpack that. Kevin Warsh. He's not a new name if you've been in finance for a while.
Yeah.
But for the newer trader, the person who came in during the crypto boom, Why does his name signal such a drastic shift?
Why does he scare the crypto bulls so much?
Yeah.
Well, we love this analogy, so let's use it. Think of the Fed's balance sheet as the punch bowl at a party. For a long, long time, Jerome Powell kept that punch bowl relatively full. Even when he was hiking rates, you knew there was liquidity in the system. The Fed put was always sort of assumed to be there.
Meaning if things got too bad, the Fed would step in and save the day.
Right. They'd add more punch. Kevin Warsh, he's like the strict parent coming home 3 hours early who thinks the party has gone on way, way too long.
And he's about to turn on all the ugly fluorescent lights and pour the punch right down the
He
sink.
is pouring the punch down the sink. Exactly. Warsh has been an incredibly vocal critic of the size of the Fed's balance sheet for years.
This isn't a new position for him.
Not at all. And he's not a career academic like Yellen or Bernanke. He's a former banker. He understands the plumbing of the system, and he fundamentally believes the Fed has distorted asset prices by keeping money too easy for too long.
So the market is terrified that he's going to come in and implement aggressive quantitative tightening, QT.
That is the absolute core of the fear. If Warsh gets in and decides to aggressively shrink that balance sheet, he is actively, deliberately pulling money out of the banking system.
He's reducing the supply of dollars.
Yes. Reducing the supply of dollars available to chase assets. And when you reduce liquidity, what's the first thing to get hit?
The riskiest stuff, the speculative assets, the things that rely on a flood of easy money and a devaluing dollar to go up.
And right now, what's the poster child for speculative assets in this macro environment?
Bitcoin.
It is. The whole thesis for many buyers was a hedge against money printing. You know, the Fed goes burr, so Bitcoin goes up.
Right.
But if Warsh comes in and not only turns off the printer, but starts actively shredding the money that's already out there, that entire debasement trade unwinds, and it unwinds fast.
It's interesting, though. Let me just challenge that for a second. We've known Warsh was a hawk. This isn't breaking news. Why is the market panicking about it now? Is this just a knee-jerk reaction, or is there something structural, something breaking under the surface?
That's the trillion-dollar question. And normally I'd agree with you. Markets are supposed to price this stuff in, but you have to look at the internal market plumbing. It's not just the fear of Warsh. It's the positioning of the market leading into this news.
Okay.
And that's where we have to talk about the institutional exit. I was reading a note from 10X Research, and they pointed out something really, really painful about the Bitcoin ETFs.
And this is a crucial point, because the ETF narrative was the big driver last year. Wall Street is here. The price can never go down again. That was the meme.
That was the meme. And a lot of institutional money did come in through those ETFs. The problem is timing.
What did they buy?
The average acquisition price for a lot of those big new holders is estimated to be around $90,000.
Ouch. $90,000. And we are trading near $68,000.
So they're not just a little bit down. They are deep underwater.
We're talking a 20-25% loss on paper.
At least. And when whales, these large institutional holders, pension funds, hedge funds, start seeing red like that, and the macro outlook suddenly shifts to a much tighter monetary policy with Warsh, they look for the exit door.
They aren't diamond hand retail HO dealers. They have risk committees.
They have risk management committees. They have stop losses. They have mandates. They are not going to hold through a potential multi-year crypto winter if they think the global liquidity that fueled the last run is drying up.
And that selling begets more selling. It triggers the algos. It forces liquidations.
It's a cascade. Exactly.
Now, I want to get a little technical here because I saw some data from Hyperliquid and CoinGlass that I think explains the violence of this move. It's about funding rates. It sounds like jargon, but this is a massive flashing red light, isn't it?
It is. This is the mechanism. So let's just quickly explain perpetual futures. It's the most popular way to trade crypto with leverage. It's a bet on the future price.
But unlike a normal futures contract for corn or oil that expires, these never expire.
Exactly. You can hold them forever, in theory.
So if they never expire, how does the system keep the price of that contract tied to the actual real-time price of Bitcoin? Why doesn't the futures price just drift off to $1 million?
That is where the funding rate comes in. It's a fee. It's a balancing mechanism. In a normal bull market, the majority of traders are betting the price will go UP. They're long.
Right.
So to keep the balance, the longs have to pay a small fee to the people betting the price will go down, the shorts.
So it's the cost of being bullish, the cost of doing business to hold a leveraged long bet.
Precisely. But that is not what is happening right now.
It's flipped.
The data shows the funding rates have turned negative. Sharply negative. That means the people betting on the price crashing, the shorts,
Yeah.
are now so numerous, so aggressive that they're the ones paying a premium.
Wait, say that again? The bears are paying the bulls.
The shorts are paying the longs just to keep their short positions open.
Wow. So bearish bets are so popular right now that people are willing to pay for the privilege of shorting Bitcoin.
It's like paying a cover charge to get into a club that's on fire.
That is a great way to put it. It's a sign of an extreme sentiment shift. The market is absolutely crowding into the short side. They smell blood in the water.
And they smell that blood right around that $60,000 level. Let's talk about the floor.
Yes, the technicals. 60K seems to be the line in the sand for everyone.
It's absolutely critical. If you look at a volume profile, which basically shows how much Bitcoin was bought and sold at different price levels, there is a massive wall of support between $60,000 and $70,000.
That's where all the accumulation happened over the last year.
It's where the battles were fought and won by the bulls. But below 60,000,
It's an air pocket.
it is a cliff.
Okay.
There is not a lot of structural support below it for quite a while. If we break 60K decisively on high volume, we could be looking at a much, much deeper correction, a reset, as some analysts are calling it.
And what does a reset mean in terms of price?
Potentially down to the mid $40,000 range. It would be a very painful move.
A reset. That sounds ominous. Okay, but here's the flip side of the coin. And this is where that divergence gets so fascinating. While Bitcoin is having this meltdown, gold, the old school heavy metal rock star, is absolutely crushing it. We just crossed $5,000 an ounce.
A historic moment. $5,000 gold.
And it's happening at the exact same moment that Bitcoin is failing its big test.
It really just shreds the Bitcoin is digital gold narrative, doesn't it?
That narrative is taking a serious beating today. The whole pitch was when the world gets scary, when governments mess up, when the Fed gets hawkish, Bitcoin is your non-sovereign safe haven.
But today, the world is scary, the future Fed is scary, and Bitcoin is trading like a risky, high-beta tech stock.
While actual gold and even silver, which is up 6% recently.
They're doing exactly what a safe haven is supposed to do. They're going up.
It creates such a stark contrast. So we have to ask the question, who is buying all this gold? Is this just panicked retail investors running away from crypto? Or is there something bigger at play? It feels bigger. I mean, retail can move the needle a little bit, but to push gold through a massive psychological level like $5,000, that takes heavy artillery.
It does. And this is a central bank story. You have to look at what's happening in the East, specifically China.
Sure.
People's Bank of China has just extended its gold purchases for a 15th consecutive month.
15 months. A year and a quarter of straight buying.
That's not a trade. That's a policy.
It's a strategic shift.
It's a massive strategic shift. They are de-dollarizing. They are diversifying away from US Treasuries. They are building a fortress balance sheet with hard assets that have no counterparty risk.
And when a player that big a sovereign nation is in the market as a consistent, non-price sensitive buyer,
it puts a huge floor under the price. It gives confidence to every other trader in the world to say, okay, the smart money, the sovereign money is in metals.
So what we're seeing is a literal rotation. You can almost picture the screens. Traders are selling the crypto that is super sensitive to the wash effect and tight liquidity.
And in the same breath, they're moving that capital into precious metals, which are supported by this massive wave of central bank buying.
It's a flight to quality.
Yeah.
A flight to history.
That's it. When the future looks this volatile and uncertain, people buy the asset that has worked for 5,000 years, not the one that's been around for 15.
Brutal.
Gut.
Seems to be true today. Okay, speaking of rotations, let's pivot to the stock market, because there's another massive shift happening right under our noses that I think a lot of people are missing. Everyone talks about the Mag 7, the big tech giants, Apple, Microsoft, NVIDIA, but they're looking a little tired.
They are. The tech LeBrons, as you call them, are gasping for air on the sidelines. And while they're catching their breath, the small caps are having a revenge moment.
I do love a good underdog story. We're talking about the Russell 2000 index, right? This tracks the smaller U.S. companies.
The companies that actually make things and ship things and bank things in the real American economy, not just the ones selling software.
And the data is pretty incredible. The Russell 2000 is beating the S&P 500, which is so dominated by big tech, by over 6 percentage points this year.
6 points. And the spread between the two is the widest it has been since 2016. That's not just a blip. That's a massive signal.
That is really significant. For years, being in small caps was like being stuck in the slow lane on the highway while these tech Ferraris just zoom past you. So what changed? Is this just a fluke? Is this just people gambling on junk stocks?
It doesn't look like a fluke. It actually looks like it's based on fundamentals, and the key word here is earnings.
We're right in the thick of earnings season, so how are the little guys doing?
They're doing surprisingly well. About 65% of the companies in the Russell 2000 have exceeded their profit expectations.
65%. That's a very healthy beat rate.
It is. Now compare that to the big guys.
The S&P.
The S&P 500's earnings beat rate is actually the lowest it has been in 3 quarters. So relative to what Wall Street was expecting, the big guys are disappointing and the small guys are impressing.
I like to think of this with a sports analogy. The S&P 500, for the last few years, has been like a basketball team that relies entirely on one superstar player.
Right, the tech LeBrons.
The tech LeBrons. She scores 50 points a game, but eventually he gets tired, he gets double-teamed, he has to go to the bench.
And the whole team stalls out.
Right. But now, suddenly, the bench players, the small caps, are coming into the game. And maybe they don't dunk as hard, but there's 5 of them, and they're passing the ball, and they're all hitting their shots. And suddenly the team, the whole U.S. economy, is winning because it has depth, not just one superstar.
That is a perfect analogy. That's exactly what economists mean when they talk about market breadth.
It's healthy.
It's incredibly healthy. A rally that relies on 2,000 companies doing well is so much more sustainable than a rally that relies on just 7 companies doing well. But we have to explain why they're suddenly doing so well. And it actually connects back to interest rates.
This is the debt angle, right?
Yeah.
Because a small manufacturing company has a very different debt structure than Apple or Microsoft.
Completely different. Think about Apple. When they borrow money, they issue long-term bonds at fixed rates. They locked in those near-zero interest rates years ago. They honestly don't care that much what the Fed does with short-term rates today. They're sitting on a mountain of cash.
But the average company in the Russell 2000?
They're not issuing bonds. They rely on bank loans. They rely on revolving credit lines. They have floating rate debt.
So when the Fed hiked rates over the last couple of years, the small guys got absolutely strangled. Their monthly interest payments skyrocketed. It ate up all their profit margin.
They were suffocating. It was a massive headwind. But now, even with all this war anxiety, the actual market rates have come down a bit from their peak. And every single basis point that interest rates drop flows directly to the bottom line of a small company in Ohio.
It doesn't really help Apple that much more, but it saves the small guys.
It's a huge earnings leverage play for them, massive operating leverage. And there's one other macro tailwind we have to mention.
Deregulation.
Deregulation hopes. If you're a massive corporation like Google, you have a department of 500 lawyers just to handle regulations. It's a cost of doing business. It's a rounding error.
Right.
But if you're a small manufacturer with 50 employees, a single new complex regulation can crush you. So the hope in the market that the new administration will be cutting red tape is disproportionately good for small caps.
I saw a quote from Michael Wilson over at Morgan Stanley. He's usually pretty bearish, you know. He's the guy who sees a cloud in every silver lining. But even he is changing his tune on this.
He is. He's talking about positive operating leverage finally returning for small caps, which is just a fancy way of saying that as their sales go up, their profits are going to go up even faster because their costs are finally under control.
And Lori Calvasina from RBC Capital Markets said the S&P has lost dominance. I mean, that is a strong statement from a major firm.
It's a very strong statement, and it signals that the easy trade of the last 5 years, just buying the index and forgetting about it, that might not be the best strategy for 2026.
You have to be a stock picker again. You have to look where the growth is actually surprising to the upside.
And right now, that is clearly in the Russell.
So we've got this wild picture, crypto crashing, gold soaring, small caps taking the lead. It's a chaotic Monday, but chaos usually means opportunity if you know where to look.
Absolutely. It's a trader's market. Volatility is our friend.
Speaking of opportunity, if you're finding value in this breakdown, if we're helping you make sense of all this madness, do us a favor. Hit that subscribe button for Theta Fuse. Leave a comment below. It really helps us get this intel out to more traders just like you.
Absolutely. And here is your favorite section. We want to know what you are watching. If you need a deep dive analysis on a specific stock symbol, maybe one of these small caps we just mentioned, or a crypto project you're on the fence about, drop the ticker symbol in the comments. We'll pick the best ones, do the homework, and feature them in our next deep dive.
Do it. We read every single one of those comments. Okay, let's shift gears. Time for M&A Monday. Big Pharma is opening its wallet, and the numbers are just staggering.
It is a full-on billion-dollar shopping spree. Eli Lilly is the big headline here. They're acquiring Ventyx Biosciences.
And this is an all-cash deal I saw.
All cash, $14 per share.
So what was the premium on that? Because I pulled up the Ventyx chart this morning, and it was trading way, way lower than that just last week.
It's a massive premium, a 62% premium over the 30-day average price.
62%.
The total deal value is around $1.2 billion.
Imagine waking up to that in your portfolio. That definitely pays for the morning coffee. But they didn't just stop there, did they?
No, in the same breath, they're also buying Orna Therapeutics for up to $2.4 billion.
Okay, so Eli Lilly is spending close to $4 billion in the span of the day or so. Why? Where is all this money coming from, and what's the strategy here?
Well, the money is coming from the obesity gold rush.
Zepbound and Mounjaro?
Exactly. Those drugs are printing cash for Lilly. They are so flush with liquidity right now, their war chest is overflowing.
So they have the classic good problem to have. Too much cash on the balance sheet.
A very good problem. But they also have a strategic imperative. They know the obesity drug boom won't last forever without serious competition. They need to find the next big thing.
So the strategy is interesting. They aren't just buying up competitors in the weight loss space. They're buying entire new pipelines.
That's the key. Ventyx, for example, specializes in inflammatory and immunology drugs, specifically pills, not injections, for things like autoimmune diseases.
So it's a totally different vertical for them.
Completely. Lilly is basically saying, okay, we have the obesity market cornered for now. Let's use that cash to go out and own the next big frontier in immunology.
It's that classic build versus buy decision every CEO faces.
Right. Is it faster and cheaper to hire 1,000 of your own scientists and pray they discover something in the next decade? Or is it faster to take your billions and just buy the smaller, more nimble company that has already done the hard R&D work?
When you have billions in the bank, the buy option becomes a lot easier.
The big takeaway here for investors is to watch these cash kings. Companies that are generating massive free cash flow like Lilly, like some of the tech giants, they are going to be looking for bargains.
And the biotech sector has been beaten down for a while now.
It's ripe for the picking. So if you're looking for, a bit of lottery ticket, and I want to stress this is risky.
Very risky.
Looking at these beaten down biotechs that have strong drug pipelines might be the play. You're basically betting that a giant like Lilly comes along with their checkbook.
It's the M&A playbook. Shopping spree season is officially open in biotech.
It seems to be.
Okay, let's take a quick trip around the globe. Our global minute. We've got eyes on Brazil and Japan today. What is happening down in Rio?
Brazil is looking cautiously optimistic, I'd say. The market there is up even with some political anxiety bubbling under the surface.
The political anxiety is practically a national sport in Brazil. What's the specific trigger this time around?
It's all focused on President Lula. He's giving a major interview this week, and the market is watching very closely for any clues about who he's going to nominate for the central bank.
It always comes back to the central bankers, doesn't it?
It's the most important job in the world that almost nobody understands.
So true.
But despite all that political noise, the corporate earnings are strong. Itaú Unibanco, one of their biggest banks, posted profits up over 13%. Porto Seguro, a big insurer, profits up 25%.
So the actual businesses are making money, regardless of the politics.
They are printing money. And as a result, the currency, the Brazilian real, is strengthening slightly. It signals a pocket of stability. If you're an emerging market investor, Brazil is looking relatively attractive right now. It's a solid earnings story.
Okay, and what about Japan? I saw the yen is slipping again.
The yen is weakening, yes. And this is a political bet, too. The currency markets are betting on a win for Sane Takaichi in the upcoming political contests.
And Takaichi is known for?
She's a big proponent of what they call reflationary policies.
Plain English, please.
She likes loose money. She wants to keep interest rates low and government spending high to try and stimulate the economy and create inflation.
Which means more yen being printed, more yen in circulation, which makes each individual yen worth less.
Exactly. But a weaker yen is usually very good for Japanese exporters.
Like Toyota or Sony.
Precisely. Their products become cheaper for the rest of the world to buy. So you might see Japanese equities get a boost from her policies even as the currency itself drops.
Got it. So Brazil is an earnings play. Japan is a currency and policy play. The world is a busy place today.
Never a dull moment in the markets.
For sure. Okay, we've looked at the chaos. We've covered The crypto crash, the gold spike, the small cap revenge, the pharma buyouts.
Yeah.
So now the big question is, how do we make money today? What is the investment strategy of the day?
Based on everything we've just discussed, that divergence is the absolute key. Tech and crypto are currently in the danger zone. Volatility is high, and the worst fear is real and tangible.
But small caps.
Small caps have fundamental strength. They have the earnings.
So the strategy is...
We're calling it the small cap value rotation.
Okay, break it down. How does someone execute this?
Look, the Mag 7 trade is crowded. Everybody and their grandmother owns NVIDIA and Apple. But the Russell 2000 is, on a historical basis, cheap relative to those large caps. And as we just saw, they're actually growing their earnings faster than expected.
So actionable steps. Do I just go out and buy the whole index?
Buying the index ETF is one way. The symbol is IWM. That's the simple approach. But you can be even more specific if you want to.
How so?
Look for specific sectors within the small cap universe that benefit most from deregulation and strong domestic growth.
For example?
Regional banks are a great example. They live and die by the U.S. economy and interest rates. Also, domestic manufacturing. These are the companies that borrow a lot of money, so lower rates help them immensely, and they operate almost entirely in the U.S., so a strong U.S. economy is their lifeblood.
And what if I'm nervous? What if I'm listening to this and I think Kevin Warsh is going to crash the whole party, small caps included? What's the hedge?
If you are looking for a hedge or just a pure momentum play this week, it's the long gold, short crypto pair trade.
You buy gold, you short Bitcoin at the same time.
At the same time, same dollar amount. It's a pure play on this safety versus speculation dynamic we've been talking about. If the market continues to get scared of tight money, that spread should widen. You're not even betting on the overall direction of the market. You're just betting on this divergence continuing.
I like it. Clear, actionable. But of course, this is the point where we have to say it.
We absolutely do. The content of this podcast is for informational purposes only. Everyone's financial situation is different, and the thoughts we provide here may not be applicable to you. We are not financial advisors. Please consult with a professional before making any investment decisions.
Really important stuff. Don't go bet the farm based on a deep dive, folks. Do your own homework. All right, let's just recap the big points before we sign off for the day. Bitcoin is in the danger zone. That $60,000 level is the floor you absolutely need to watch. If it breaks that, look out below.
Gold is the new king of the hill at $5,000. The central banks are buying, and the momentum traders are following their lead.
And small caps are the smart money trade right now. The bench players are winning the game based on real earnings.
And M&A is heating up. Keep an eye on those cash-rich companies looking to buy up innovation on the cheap.
I want to leave you with one final provocative thought. We talked a lot about Kevin Warsh and the fear of him tightening the Fed's belt. We focused a lot on how that hurts Bitcoin. But I want you to think about this.
Go on.
If he actually does shrink the balance sheet, if he really does drain that punch bowl for good, it won't just be Bitcoin that feels the cold.
No, it certainly won't.
It could be the entire everything bubble. Real estate, collectibles, high-growth tech stocks that still don't make a profit. If that liquidity tide truly goes out, we are going to find out who's been swimming naked across the entire economy.
That's the real systemic risk. And the question everyone needs to ask themselves is, are your stop losses set?
Exactly. Are your stop losses set? Something to chew on. Keep trading smart, everyone. We'll see you next time on Theta Fuse.